think about the last time you took a massive loss in the market. That sudden sinking feeling right in the pit of your stomach. The instant spike in your heart rate. The hot flush of anger. And then that overwhelming, burning urge to immediately jump back into the market. The desire to double your position size, break your rules, and win your money back right away. Welcome back to Prohitclub. If you have felt that exact mix of anger, panic, and desperation, I want you to take a deep breath. You are not a bad trader. You are just a human being reacting to financial pain. But here is the brutal truth that nobody else in the trading community wants to tell you. The market did not steal your money. Your inability to accept being wronged it. In trading, your true edge doesn't come from a perfect technical indicator. It doesn't come from a secret algorithmic strategy or a magic candlestick pattern. Your edge comes down to how you behave in the 60 seconds after you hit a stop loss. Most retail traders spend 90% of their time looking for a high probability setups, and they spend almost 0% of their time practicing how to lose cleanly. Today, right here on Prohitclub, we are changing that. In this video, we are diving deep into the raw, unedited psychology of managing trading losses. By the end of this video, you won't just learn to tolerate your losses. You will understand exactly how to use them as a mechanical tool to scale your account safely. If you are ready to stop bleeding capital and start trading like a professional, make sure you are locked in. To defeat the emotional cycle of losing, you first have to understand what is happening inside your brain when a trade goes red. Our brains were evolved over millions of years to protect us from physical threats. Back in the day, a threat meant a predator or starvation. When you look at your trading screen today and watch your account balance drop, your brain doesn't see digital numbers. It processes that financial loss as a literal threat to your physical survival. This triggers a specific part of your brain called the amygdala. The amygdala is the emotional, primitive center of your mind. The moment a trade moves against you, your amygdala takes over and fires off a massive wave of cortisol and adrenaline. This is the classic fight or flight response. When this biological response happens, something dangerous occurs. The prefrontal cortex, the logical calculating part of your brain that you use to analyze charts, essentially shuts down. Psychologists call this an amygdala hijack. Suddenly, you are no longer a rational business owner executing a calculated risk strategy. You are a panicked animal trying to survive a perceived attack. And what does a panicked animal do? It fights back blindly. In trading, that fight back mechanism manifests as the single most destructive habit in the game, revenge trading. Recognizing this chemical shift is your absolute first line of defense. When you feel that sudden heat in your chest after a losing trade, you need to pause. It's not your strategy that is failing you in that exact moment. It is your biological programming trying to hijack the steering wheel. Let's look at the 3 specific psychological traps that break almost every retail trader out there. The first deadly mistake is moving your stop loss. We have all done it. The market approaches your exit level and a little voice whispers, just give it a little bit more room. It's a great setup. It's bound to reverse any second now. This is pure hopium. When you widen your stop loss mid-trade, you break the contract you signed with yourself before you enter the market. You instantly transform a controlled, calculated risk into an emotional, open-ended gamble. You are refusing to accept that this specific trade was wrong. The second deadly mistake is revenge trading and doubling down on a bad position. This is the infamous Martingale trap. You lose $500 on a trade. To fix it, you instantly enter a brand new trade with double the lot size to make that money back plus a quick profit. But if that second trade fails too, you are suddenly down $1,500. Now the emotional damage isn't just doubled, it's multiplied exponentially. Real panic sets in. This is exactly how traders end up blowing months of hard-earned gains in a single chaotic afternoon. The third deadly mistake is analysis paralysis and execution fear. This is the opposite extreme of the spectrum. After taking a tough string of consecutive losses, a trader will completely freeze up. They will see a perfect setup materialize on the charts. It ticks every single box in the trading plan perfectly, but they cannot bring themselves to click the execution button. They are so traumatized by the memory of the previous losses that fear paralyzes them. They sit on their hands, watch the trade hit take profit without them, and then get frustrated all over again. Here is what you must understand deeply. The market does not know who you are. It does not care about your specific entry price. It does not hold a personal grudge against your bank account. Every single trade you take is an entirely independent statistical event. What happened on trade number 1 has absolutely zero structural influence on whether the trade number 2 will win or lose. The moment you link your past losses to your current execution, you completely destroy your statistical edge. So, how do professional traders view losses? They don't look at them as failures or stains on their reputation. They look at them as the basic cost of doing business. Let's do a quick reality check outside of the financial markets. Imagine you decided to open a physical clothing retail store. To run that business, you have to pay monthly rent. You have to pay electricity bills. You have to buy wholesale inventory, and occasionally some of that inventory gets damaged, lost, or simply never sells. When you pay the electric bill at the end of the month, do you sit there weeping? Do you feel like a failure? Do you think your entire business model is fundamentally broken because money left your account? Of course not. It's just an operational expense required to keep the lights on so you can make a profit. In the trading world, your losses are your inventory. They are your electric bill. There is no such thing as a trading strategy with a 100% win rate. It does not exist on this planet. Even the most elite hedge fund system in the world operate with win rates hovering around 50 to 60%. They make millions of dollars because their average winning trades are significantly larger than their average losing trades. When you hit a stop loss, your strategy is simply paying its operational cost. If you risk 1% of your account on a trade and lose it, that isn't a mistake. It is just the necessary cost of finding out whether that specific market pattern was going to pay off this time. The moment you stop treating a loss as an insult to your intelligence and start treating it as a standard business line item, your emotions will completely flatten out. Now let's get practical. How do we build a structural system to protect our capital from our own emotions? At Prohitclub, we implement a strict 3-step mechanical framework to manage losses automatically. Step number 1 is the absolute maximum risk rule. Before you ever look at a chart or pull up an order ticket, you must define your risk per trade as a fixed percentage of your total account balance. for most developing traders, this absolute ceiling should be between 1 and 2%. If you have a $10,000 account, you are risking $100 to $200 per trade. No exceptions. If a potential setup requires a wider technical stop loss due to market volatility, you do not increase your financial risk. Instead, you decrease your position size. The dollar amount at risk must remain constant. Step number 2 is the daily circuit breaker. You need an automated daily max loss limit set directly with your broker or with your trading plan. Think of this as a safety fuse box for your mind. If your daily limit is the 3% of your account and you hit 3 consecutive losses in the morning session, your trading day is officially over. You close your laptop, you shut down your trading platform, and you walk away from your desk and do not try to make it back. During the afternoon session, your brain is emotionally compromised after hitting a daily max loss, and staying in front of the screen will only lead to further account destruction. Step number 3 is the mandatory post-loss routine. When you take a loss, do not immediately scan the charts for the next available setup. Take a mandatory 5-minute break. Step away from your screens entirely. Drink a glass of water. Walk outside. Let the physical adrenaline spike wash completely out of your nervous system. Once you are completely calm and your heart rate is normal, open your trading journal. Document the loss objectively. Ask yourself, did I follow my rules? If the answer is yes, then that was a good loss. Take a screenshot, log it into your journal, and move on with a clean mental slate. True mental resilience is this game isn't about your hiding your emotions or pretending you don't care about money. It is about building a rigid structural environment that protects your capital when your emotions are running high. Amateur traders are completely obsessed with how much money they can make on a single trade. Professional traders are completely obsessed with one thing only: risk management. They focus entirely on protecting their downside. Why? Because they know that if they preserve their capital, the upside will naturally take care of itself over time. Every single time you take a loss cleanly, accept your stop loss and walk away without breaking your rules. You need to celebrate that. That is a massive psychological victory. You are actively training your brain to understand that a loss is not dangerous. You are reinforcing your discipline muscle. Over months and years, that exact discipline is what separates an inconsistent, frustrated retail trader from a consistently profitable professional. Building a successful long-term career in the financial markets is a marathon, not a short sprint. Do not let one bad day or one emotional week wipe out months of hard work, consistency, and growth. Thank you for tuning into this deep dive into trading psychology here at Prohitclub. If this video helped you reframe how you look at your losing trades, do us a huge favor. Drop a like below, leave a comment sharing your personal rules of handling a bad trading day, and make sure you are subscribed to the channel. Protect your capital, stick to your plan, and we will see you in the very next video. Safe trading, everyone. Thank you.